As time goes on and with more and more certainty that the Federal Reserve is in fact going to cut interest rates sometime soon, which as of right now on September 18th, which is just right around the corner, there's a 25 basis point cut being priced in at around 90% probability. Not to mention by November this year, there's also a very decent chance that rates are going to be much lower than they are as a current. And by around this time next year, there's even a small chance being priced in that interest rates are going to be about half of what they are currently. Now, because of the certain interest rate cuts ahead at some point at least, there's a massive rotation happening in the market right now, and different names like SHD, for example, is finally getting some much needed love, along with other popular names like Realty Income as well. But in this video specifically, we're going to talk about an ETF that I currently hold in my portfolio that I've been holding for a while now. That just happens to be very, very sensitive to interest rates, and I think this ETF is going to do amazing over the next year and beyond. But that's only if us investors get in on the action ASAP. So if you want to see which ETF I think is going to rocket over the next few years because of interest rate cuts, make sure to stick around, drop a like down below, and let's get right into this one. Real quick, for those that haven't already, make sure to go to the first link in my description and grab my new dividend investing ebook, where I share exactly how I went from $0 invested to now earning over $6,000 on a monthly basis and over $1 million invested in the market. Along with the ebook, you're also going to receive my custom dividend tracker, where you can track your dividend progress on an ongoing basis and reach your dividend investing goals. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Now, the ETF that I hold in my portfolio, and one of the ETFs that I think is going to be seeing a lot more love sometime soon here because of interest rate cuts, is none other than VNQ, or the Vanguard Real Estate ETF. Now, in the product summary, this ETF says it invests in stocks issued by real estate investment trusts, or REITs, companies that purchase things like office buildings, hotels, and other real estate. Now, this ETF offers high potential of investment income, which this ETF does pay a very decent dividend yield, but also this ETF has a potential to move up quite a bit in share price, which it has even over the last few weeks. Now, before we dig a little bit deeper into VNQ and I explain exactly why I think this ETF is going to see some much needed love because of the fact that the Federal Reserve is going to be cutting interest rates substantially over the next year, looking at some more of this ETF's metrics, the expense ratio is 0.13%, so this ETF, just like all other Vanguard ETFs, is pretty cheap to own. Now, in the 1 year time frame, this ETF is actually in the green, up 4.5%, which is shocking considering a lot of real estate investment trusts, or REITs, have been getting knocked down like crazy over the past year. Year to date though, VNQ is basically flat, and if it wasn't for this recent recovery that we've seen over the past few trading days, this ETF is up around $5 or $6 just over the last few days, and this move of course is largely tied to interest rates. Now, VNQ, as we talked about, does hold real estate investment trusts, or REITs. Some of the largest holdings in this ETF though, number 1 is going to be the Vanguard Real Estate 2 Index. Prologis is number 2. Then AMT American Tower, we have Equinix, we have Welltower, Simon Property Group, Realty Income of course, Digital Realty, Crown Castle, and Public Storage. Now, all in all, as of right now, this fund has around 163 different REITs in it. So if you want some real estate exposure, but you're not necessarily sold on any individual REIT, VNQ is an absolute beast. Now, looking into VNQ's dividend, which is going to be very important, especially if you're a real estate investment trust investor, you want to get paid a decent amount of cash flow, which VNQ definitely offers. Around a 3.97% trailing 12-month dividend yield, which isn't bad whatsoever. But if I'm going to be honest, one of the negative parts that I don't really like about VNQ, even though I hold quite a bit of it, this ETF hasn't really had all that much dividend growth historically. It's basically paid more or less the same amount of dividends, which I would say honestly is probably one of the worst parts about this fund. Back years ago, VNQ was offering super high dividends. This was pre-2008. But since then, VNQ's dividends have been a little bit smaller, and although they are going up into the right over time, there's not any substantial dividend growth here. Now, this is also because a lot of real estate investment trusts don't have the fastest dividend growth historically, although there are some names out there that VNQ does hold in the portfolio that do have some faster dividend growth than others. All in all, to say that if you want exposure in an ETF with some super fast dividend growth historically, well, VNQ might not necessarily fully tick off exactly what you're looking for. But now digging into it, some of the reasons on why I think these rate cuts up ahead are going to substantially affect REITs and VNQ on top of that. In this article, it says the conventional wisdom of the market is that REITs do poorly in rising interest rate markets and do well in falling interest rates. One would need to look no further than the inverse correlation between the Vanguard Real Estate Index, or VNQ, and compare that to the 10-year Treasury yield, or the US 10Y. It has now been multiple years of REITs trading down on the majority of days on which interest rates went up. So interest rates in REITs are going to be very tightly correlated. And like they said in this article, they basically trade as an inverse. As such, it would seem that falling rates should generally be a tailwind for REIT stock prices. However, I think it's much better to understand and see So we shall examine the mechanisms through which interest rates impact REITs or real estate investment trusts. Now, positive impacts of falling interest rates on REITs. Listen very closely, especially if you own REITs or especially if you own VNQ. Now, cap rates decline, not parallel. This is again when rates fall. Now, on top of that, transaction volume is going to return and probably move up. Cost of capital is reduced, unlocking acquisitions. It's going to cost real estate investment trusts much less money to acquire new properties, to expand to play in the offense, because not all REITs are like Realty Income. Not all REITs have a ton of capital just basically locked away. A lot of real estate investment trusts utilize debt, which is going to be very costly when interest rates are expensive. On top of that, multiple expansions, interest expense reduced, TINA returns, and M&A stimulated. But with that, there's also some negative impacts of falling interest rates on REITs. Number one, it's going to be construction becomes more feasible. And number two, ownership becomes more viable, possibly reducing tenant demand. So when interest rates move down, ownership is also going to be more viable for everyday people. It's going to be easier to afford to buy your own house when interest rates move down, which means real estate investment trusts, especially those that deal with apartment buildings, could see some pain there. It then said overall impact of interest rates. I think cuts will be quite beneficial to the market prices of REITs through restoring FFO multiples back to normal levels. Fundamentally, interest rates are more neutral. REITs function best when the 10-year treasury yield is somewhere between 2.5% and 6%. A couple of cuts is fine and probably beneficial because it will help the yield curve, but we would rather not see a return to a zero interest rate policy, which is what we saw for several years. Now, REITs best positioned to take advantage of falling interest rates. While it could be a tailwind for REITs in general, there are two categories of REITs that they think could be benefited substantially. This is going to be discounted preferreds or moderate to high leverage with strong businesses. So even though VNQ, one of the highest quality, one of the most popular real estate index funds across the entire market, has seen a little bit of a revival, trading a lot higher towards the 52-week range high than the low, which is awesome. There's still a long way to go until we see VNQ possibly hit a new all-time high. We're still at least $20 off from that. Now, could this possibly mean that VNQ trading in the high 80s could be a potential buying opportunity, especially for investors willing to hold on to this ETF for a year or so? I think it definitely potentially could be. But even more than VNQ, I think buying into high-quality real estate investment trusts across the entire market could still be an opportunity and maybe be one of the last chances we're going to see, because once interest rates start to get cut, I think REITs across the entire market, for the most part, are going to be off to the races. But when it comes to VNQ or REITs tied to interest rates, I want to hear from you guys down below. What is your number one position across your entire portfolio when it comes to real estate, when it comes to REITs? Drop the ticker symbol in the comments down below. If you enjoyed this video, make sure to please drop a like on it and subscribe for more future content like this. So make sure to grab yourself a copy of my dividend investing ebook and the new dividend tracker today. It's the first link in my description. Thanks as always for stopping by. And if you are interested in investing, make sure to check out these recent videos I posted right here.